Let's get started. Welcome everybody to I guess that's our second seminar in the WEFI lecture seminar series of 2021. Most of you have been here before, so you know the format, but those of you who are new, let me just give you a brief rundown of how things are going to work today. So Will here is going to have 40 minutes once I'm done talking to present his paper. We'll use the chat to ask questions. If you have any questions, use the chat, and Song or myself will basically decide whether we can interrupt Will or we wait to the final 10 minutes Q&A. We may ask you to unmute, so be ready for that if we think your question demands it. Then we'll follow up with the discussion, 15 minutes, and then again end with the Q&A in 10 minutes. So with that, let me introduce Will. Will Gornall is an assistant professor of finance at UBC. He has, in his young career, already made an important set of contributions to the venture capital literature. This paper is a next step in one part of that, contributions on venture capital contracting. I'm really excited to see it. I saw a very early version. I'm curious to see how it's changed, if at all. Will is going to have 40 minutes, and again, interrupt or use the chat to provide any questions. And with that, I'll hand the floor over to Will. Thanks.
Awesome. Well, thank you so much, Mike. I'm really happy to be here. Today, I'm going to talk about a project that looks at valuing venture capital-backed companies in the presence of multiple future financing rounds. We're going to take venture capital valuation models, which generally either ignore financial terms completely or consider financial contracts only as written and ignore future rounds. And we're going to take those types of models and we're going to extend them to a world where we have future financing rounds that involve dilution, that involve subordination, that involve claims interacting in complicated ways. Anyway, the question is, how does modeling these future rounds impact the value of securities today? So valuations are important. There's a huge microstructure literature arguing that prices matter for real outcomes. But in venture capital, I think that's really clear. We're not talking about whether moving from a 0.001 to a 0.01 tick size or something like that matters. We're talking about whether valuations should be improved when these valuations are plus or minus 10 or 20%. The fact that valuations are inaccurate creates real problems for investment. It makes it harder to select managers. When limited partners can't trust the reported asset values, that makes it difficult for them to evaluate managers. That makes it harder for managers to develop a track. It makes it harder to trade on secondary markets. When net asset values are not an accurate representation of how much securities are worth, it's hard to trade those. It makes it harder to allocate your portfolio and risk manage if you're a limited partner. And it makes it fundamentally harder to make real investments. It impedes the investment of money going into real companies. So valuation is very good. Accurate valuations would be great, but valuation in this space is hard. It's hard for several reasons. Primarily, it's hard because it's difficult to predict cash flows. We have highly speculative companies with very skewed cash flow distributions. On top of that, we're layering a complicated financial structure. Venture capital-backed companies raise money round after round from a variety of different planets. This financial structure makes it even more complicated. And on top of that, we're layering information frictions. Many of the claimants in venture capital-backed companies don't have the information they might like to value these companies. If you're a mutual fund investing in a late-stage venture capital-backed company, you might not have the right information to mark your securities to market after you've invested. So to illustrate how these frictions can matter, this is the case of WeWork. This is a chart of the reported share prices for WeWork as reported by mutual funds. The y-axis is the share price reported, the x-axis is the date. Each of those black dots corresponds to a different reported share price for WeWork shares on a particular date. And the red range, the red blob, is the range in reported prices. So if you see, for example, mid-2018, you can see that some mutual funds were reporting WeWork shares as being worth about $110, while other mutual funds were reporting those same shares as being worth about $40. There's a huge range in prices. The same type of security is being reported because these mutual fund investors overwhelmingly invested into a small number of rounds that were light in terms of cash flow terms. So we see the same security being marked as different prices by different investors. And that's undesirable. That's undesirable if you're picking managers. It's undesirable if you want to trade this thing. It's undesirable for a number of reasons. So where does this difference in opinion come from? Well, many of the investors in this space are valuing securities simply by marking things the most recent share issuance. There are three broad approaches. This is the simplest. It's the first approach I'm going to talk about. If you do this, when a venture capital-backed company raises round after round after round, you take your securities and you say that they have the same value as the securities issued in the most recent financing round. That makes intuitive sense. These rounds are negotiated between sophisticated investors on both sides of the table and entrepreneurs as well. Ideally, these prices should be fair. As long as we're not SoftBank investing in WeWork, they should reflect reality. So it makes sense to try to use these prices to mark your own assets to market. They're a tangible, verifiable reference price. Because of this, many mutual funds, some VC funds, some academics use this type of practice, marking their share prices to the most recent financing. The challenge, as was pointed out in my prior paper, as was pointed out in Yesuda and other work, is that each of the share issuances has different contractual terms. So if you want to mark Series A shares to the price of Series B shares, you're valuing apples by comparing the prices to oranges. To illustrate this, this is a payout diagram for SpaceX Series B shares at the time of Series B. I have common shares, payout per share, per common share on the y-axis as a function of the exit value on the x-axis. Common shares are paying out more as the company does better. Series A shares are paying out what common pays out, plus some additional downside protection. On the left side, Series A does better than common, and Series B does even better than Series A. So each of these share classes has different contractual rights. They have different downside guarantees. Series B is getting more than Series A, which is getting more than common. So a valuation model that marks Series A shares to Series B shares, or marks common shares to Series B shares, is missing this distinction, and it's overstating the value of Series A or the value of common because of it. So we can try to fix this. We can bring in Black-Scholes. We can write out a sophisticated financial model to try to value the securities as written. So Metric and Yesuda, my previous paper with Ilya, tried to do this, building out models to value companies based on the securities that they have written. This is great as long as the companies are very close to exit. This approach is going to fall apart if you're trying to value an early stage company. Because for early stage companies, each subsequent issuance dilutes, subordinates, otherwise impacts the rights and features that were granted to prior issuances. So Series B impacts the payoff of Series A. I have a beautiful quote from Mark Zuckerberg to illustrate this. Is there a way to do this without making it painfully apparent to him that he's being diluted to 10%? New rounds can lead to significant changes in the value of the stakes of existing investors. Like Mark Zuckerberg's case, where they flat out tried to rip off one of their existing owners. So again, thinking about SpaceX, we're going to look at the payout to SpaceX Series B shareholders and how that was impacted by future rounds. After Series B, their payout looked like this, like we saw in the previous chart. Again, the y-axis is the payout per share as exit value on the x-axis varies. You can see the combination of downside guarantee and upside potential. After Series C, some of the downside protection was eroded. After Series D, it was eroded even more because Series D subordinated Series B. Series E, again subordinated, again eroding the value of that protection. And Series F completely obliterated it. We see future financing rounds destroying the value of the downside protections that earlier financing rounds had, either by subordinating them or just by heavily diluting whatever the guarantees are. So valuation model that took the Series B contract as written at the time of Series B and assumed that was static is missing something. So there's a third type of valuation model, which is kind of the inspiration for what I'm going to show you today. This is called a probability weighted expected return method. In this method, what they do is they project out several scenarios. Each of those scenarios has some future rounds followed by an exit. You discount the payoffs in each of those scenarios, and you take a weighted average across. And this type of method is used by VCs, used by some valuation firms. You may have taught it as the first Chicago method. You can make this more and more complicated. This type of method is great. It seems like it's solving all the problems I've identified. The problem is that this method is done in an almost completely ad hoc way. The scenarios are extremely subjective. They rely on information investors might not have, and they don't really make future rounds fairly priced or discipline this with the data in any way. So we see all of those values for WeWork. That's coming from different projected outcomes by different investors in WeWork. There's no discipline on this type of method. What I'm going to show you today is a method that tries to combine the discipline of the option pricing methods with the ability to incorporate future financing rounds. I'm going to take this probability weighted expected return method, which is basically just projecting out 5 scenarios in Excel that you make up. And we're going to see, can we do this in a risk neutral world? Can we do this in a rigorous replicable way that is verifiable, that is eternally consistent? So, like I said, we're the first valuation model for VC that's going to combine option pricing with future financing rounds. We think this is really important because future financing rounds are perhaps the most important, perhaps the most distinctive feature of venture capital contracting. And existing valuation models pretty much ignore this. By doing this, we're going to be able to answer some important questions. We're going to be able to talk about how future round impact current owners. And we're going to be able to talk about whether existing valuation models are reasonable. Is it better to assume that contracts don't matter since they're going to be stepped on and diluted away anyway? Or is it better to ignore future rounds because the effect of future rounds might not be that great? By building out this type of model, we can answer that question. We can talk about what methods work, how much, assuming contracts are valued as written, how much that's going to overstate the impact of contractual terms. This turns out to be a bit tricky though. What I'm going to show you today is a bit complicated. It's complicated for several reasons. One of them is that if you want an internally consistent pricing model, then the pricing of every round impacts all other financing rounds. The value of Series A shares, the valuation that they're issued at, is going to depend on the valuation of Series B shares, because the valuation of Series B shares is going to impact the dilution that Series A shares face. At the same time, the valuation of Series B shares is going to depend on the valuation of Series A shares. Every valuation of future financing rounds is going to depend in that manner on every previous valuation and every future valuation. On top of that issue of interrelatedness, there's an innumerable variety of potential terms. There's all sorts of exotic venture capital contracts. I think that's one of the reasons why this is so fascinating from a capital structure perspective, is the diversity we see. But that diversity and the fact that these terms interact in complicated, nonlinear ways is going to make this especially challenging. As just a brief example, a term like anti-dilution protection, the value of that term is going to depend not just on what the prices of the future rounds are, but also on the terms of those rounds, because those terms are going to have a nonlinear impact on future prices and the value transfer there. Because of this, solving out this model is essentially solving a high-dimensional fixed point problem. We're going to be solving for a set of valuations that consistently prices everything at once. So that's a bit tricky. That's a bit complicated. I'll see if I can simplify that a bit. We have the classic models, which take a known initial financial structure and project out a bunch of random exits. What we're doing is we're taking that type of model and we're adding in an intermediate stage. We're adding in a future investment round. That future investment round is going to have random terms. And after that future investment round, we're going to project out exits. So we're adding in future investment rounds and then future investment rounds and future investment rounds. Rather than going from Series B, projecting out exits, we're going to do Series B. Series B can either exit or it can have a Series C round with random terms. If there's a Series C round with random terms, then we're either going to have an exit or a Series D round with random terms, and so on and so on and so on. The idea is to try to model this in a realistic, in a disciplined way. And each of these exits, each of these investments is going to be calibrated based on the data we see to the best of our abilities. The distribution of exits based on M&A or IPO exits as we see in the data. The investment terms of future rounds are going to be based on the types of investments we see in the data for follow-on rounds with different characteristics. So our model of the value of the firm is a geometric Brownian motion. We're overlaying this model of financial structure on top of a firm whose value evolves corresponding to a geometric Brownian motion. You can see that on this chart. The value goes up and down based on the randomness in the process. It jumps up when investments occur. If you put $3 million cash into a startup, the startup's value increases by $3 million under our assumptions, and it eventually proceeds towards an exit. Our parameters are taken from the literature where possible. We're having the volatility of this process of 90%, exits occurring at a rate of 0.2 for a Poisson arrival rate, future rounds occurring at a rate of 0.4 Poisson arrival rate. That means that exits are occurring after about 5 years, and future rounds occur every 1.8 years, conditional on there not being an exit. In this world, assets grow at some rate. Under a traditional option pricing model, they would grow at the risk-free rate. In our model, we're extending that. Assets in our model are growing at the risk-free rate plus a risk premium that venture capitalists capture, or plus a premium that venture capitalists capture based on illiquidity, based on their managerial skill, based on their selection process, or based on some other frictions. The idea is we can't have the assets growing at the risk-free rate, because if the underlying assets grow at the risk-free rate, the growth returns of the venture capital fund will be equal to the market, and the after fees returns of the venture capital fund will be negative. We're adding in this alpha, this excess returns to venture capital assets, because that alpha will make it so that venture capitalists break even after fees. Our alpha of about 5.3% gives us a PME on venture capital investments of about 1.3, which means that after fees, limited partners will approximately break even. So this is our model of the underlying asset value. We're going to layer a financial structure on top of that. Thinking along the lines of Fisher separation theorem, the financial structure is going to be independent of the underlying real situation of the company. The financial structure is not going to impact the real cash flows, except to the extent that cash injections increase the value of the company. We're going to take this financial structure, we're going to model it based on the contracts that venture capitalists actually use. We have convertible preferred stock, which is a standard security in venture capital financing. We're going to enrich this convertible preferred stock with standard venture capital terms. We're going to have liquidation preferences, which give a guaranteed downside protection to investors, which make them senior over common shares. We're going to have seniority, which allows some classes of investors to be senior over others. We're going to have participation, which gives extra shares to VCs. And we're going to have anti-dilution, which is extra shares given if the company raises money at a lower price than what investors paid. These are very standard terms. These are the essential terms that are captured in venture capital databases, and we're going to incorporate them all based on their prevalence in the data. So I'm seeing a question from Song about the GBM assumption, whether a geometric bounding motion is reasonable given the underlying volatility, given the underlying exponential properties of the venture capital distribution, and whether the GBM is reasonable. The answer is, the testing we've done suggests that it is. So when I look at the exits, when I look at the actual distribution of values, it looks close to log normal. Keep in mind that a log normal process with 90% volatility is really, really skewed. So you see lots of really, really big exits and lots of low exits. So 90% volatility is what's used in the literature. It's close to what was calibrated based on, I think, Arthur's prior paper looking at this. We built out another version of this that uses real options, that has pricing at time, that has the pricing conditional on real options model. So views the value of the company as an option on, as an real option rather than as a GBM. And we found broadly similar results. But point well taken, we're modeling this using a geometric Brownian motion. There's a bunch of assumptions that make that valid for the Black-Scholes model, including tradability, and we don't have those assumptions. We're using this as what we see as a reasonable model, because we don't necessarily have the data to do a more, we don't have the data to project out a more accurate version of value evolution. And GBM is, of course, the most common way to model financial assets.
Thank you.
So talking about terms, I have all of these financial terms that I've talked about. Conditional on the terms of a round, the round is going to be competitively, going to be fairly priced. So we're going to take a set of terms, we're going to generate those terms, and we're going to set the valuation so that the round is fairly priced. Keeping in mind when I say fairly priced, that's fairly priced after VC fees. All of these rounds are going to make money. All of these rounds are going to beat the market, at least in expectation, but venture capital fees are going to make it so the eventual investors only break even. So we project out future rounds and past rounds based on Genesis and PitchBook data. Covers about 20,000 companies raising about 40,000 rounds. This data shows a huge amount of contractual diversity with lots of interesting terms, lots of investors getting seniority, getting participation, or getting high liquidation multiples. Our model, we're going to apply to existing companies based on the data we have, and then we're going to project out future financings based on how terms occur in the data. So to show you this quickly, this is how we do this. We project out future rounds based essentially on the results of regressions. We calibrate out probit models for the binary, for the 0-1 terms, and we use OLS to project other terms that are continuous. So our liquidation multiple parameter, we calibrate, we run a regression on the data, finding what determines liquidation multiple, and then we use that regression specification to simulate out liquidation multiples in future rounds. Our future round terms are going to be based off several features. Again, trying to let the data be our guide. When we looked at the data, previous rounds had a strong influence on current rounds. If a previous round had a high liquidation multiple, the next round was much, much more likely to have that liquidation multiple. If a previous round had a value change that was negative, again, we were much more likely to see a high liquidation multiple. So terms were overwhelmingly following the same terms or overwhelmingly following down rounds. If you raised an investor-friendly round in the past, you were more likely to have an investor-friendly round in the future. And if your company had a value decrease, you were much more likely to have an investor-friendly round. So based on this type of regression, based on these models, we simulate out a set of future contractual terms for the company. We simulate out this stochastic path of future financing, and then price each of these financing rounds one by one. So another question. looking at holdings of mutual funds, returns on companies, trying to continuously track the value of VC-backed firms. Is GBM a good model for calibrating based on what we see in the actual data? Well, so that's a great question. There have been a couple of papers that have tried to do this by looking at the publicly traded venture capital backed companies and how their values evolve. In general, they show a couple of problems. I think that in the models they've seen, in the models I've seen there, GBMs seem reasonable, but I'll look at that a bit more specifically. That's a good idea. One of the underlying issues with looking at the holdings of mutual funds or SPACs is just reporting. So publicly traded venture capital funds might work, but mutual fund or SPAC reported asset values are going to create a problem because those reported asset values are not very good. I'll show you that in my final slide. If we try to use these asset values to calibrate our model, well, those asset values show the company value just not changing for years and then jumping 100% in one direction or another. So we can't really use the reported asset values because those values are not accurate. We could look at the value of publicly traded equivalents. Those seem to be close to GBM, but again, it's hard because there's lots of additional frictions in those publicly traded companies, or rather, there's a lack of a bunch of additional frictions. So with that model in place, apologies, I've kind of rushed through this. There's a lot of complexity there. I'd encourage you to look at the paper if you want, if you're just so excited about the complexities of this like I am. With that model in place, let's talk about the results. We're going to present the results here in terms of overvaluation, in terms of the extent to which the post-money valuation overstates the true value, or the extent to which the most recently issued share is not representative of the value of the company. So if the most recently issued share is far more valuable than the average share on the company's capital structure, we're going to get a high overvaluation number. If the most recently issued share is very close in value to the other shares in the company's cap table, we're going to get a low overvaluation number. We're going to get an overvaluation number of 0. This overvaluation number is the extent to which the most recently issued share is better than the average share the venture capital that company has. So if we plot this out, we have different overvaluations for different companies. This chart shows how overvaluation of first financing rounds changes over time. I'm going to show you 3 lines. The first line here is overvaluation if we ignore financial terms, and that's just 0. If we ignore financial terms, all rounds are the same, so there's no overvaluation. All the shares have the same value. Overvaluation is on the y-axis and the year is on the x-axis here. If we ignore future rounds and take contracts as written, we see high overvaluation. First financing round had overvaluation of 70, 80% in the early years of our sample, decreasing to about 30 to 40% in the more recent years because of a trend toward what are called founder-friendly terms that have less protective features for VCs. So these are the 2 base cases, ignoring future rounds and ignoring terms completely. In our model, where we include future rounds, we're seeing something between those, but much closer to ignoring future rounds. If we consider future rounds, overvaluation falls a bit, falls by maybe a quarter, but stays quite high, especially in the recent years. So why is that? Well, we're seeing this decrease in overvaluation driven by a small number of terms. Considering future rounds dramatically impacts the value of some financial terms, while not much impacting the value of other terms. Terms like seniority or high liquidation multiple see their value greatly impaired by modeling future rounds. If you model future rounds, senior securities lose much of their value because of the precedence effect we talked about previously. A senior round today means that the future round is very likely to be senior. That senior round will subordinate the existing claimants. So the great senior securities that venture capitalists negotiated for become subordinated themselves and lose much of their value. Same idea for high liquidation multiples. If you negotiate for a high liquidation multiple today, that greatly increases your valuation in models that don't consider future terms. But if you consider future terms, and especially if you consider this precedence effect, a high liquidation multiple today loses much of its value because a high liquidation multiple is followed by a high liquidation multiple, which erodes the value of that contractual term. Your debt gets diluted by future debt issuance. So I have a question from Mike asking about whether we've surveyed VCs about what they think about overvaluation in their own rounds. So that's a great question. I really believe the survey methodology can add a lot of value. I haven't asked that question. That's a really interesting thing to look at. And I'll note that and consider that. Thank you. My impression from just talking to VCs is they don't have a good idea of exactly what the overvaluation is, that they know that their shares are worth more, but that it's quite hard, especially given the relatively limited sample that most VCs see and the what I would call relatively non-analytic approach they take to this modeling in general. So one of the really exciting results that came out of this paper is that founder-friendly financial terms hurt founders. If future rounds are fairly priced, and again, this is an important assumption, if future rounds are fairly priced, giving terms that are known as founder-friendly to new investors transfer value from founders to existing investors. And when I say founder-friendly, I'm talking about terms like low liquidation multiples, a lack of participation, etc. So why does this happen? Well, it happens because existing investors have claims that are more debt-like, and founders have claims that are more equity-like. From corporate finance, from classic corporate finance, we know that if you're a debt holder, you don't like debt issuance and you like equity issuance. Whereas if you're an equity holder, you often prefer debt issuance rather than equity issuance. This could be called debt dilution. So applying this intuition, investors who have debt-like securities are hurt by the issuance of more debt-like securities. Founders who have equity-like securities benefit from the issuance of debt-like securities. But debt-like securities are exactly what investor-friendly rounds are. By giving additional downside protections to the new investors, we're making their securities more debt-like, which is diluting the value of the downside protections given to existing investors. I can show this graphically. Imagine we have a Series B capital structure that looks like the chart on, or a Series A capital structure that looks like the chart on the left. Again, we have the company exit value on the x-axis and the per share payoff on the y-axis. The blue area is what common shares get. The red area is the additional value that Series A shares have because of their downside protections. Top right, what happens if we raise a round using common equity? Common equity is going to be subordinated to the existing Series B investors. It's going to increase the value of their guarantees. Moreover, common equity will have a low share price, so it might boost the Series A value further due to anti-dilution terms. This would be a maximally founder-friendly round, just for illustration purposes. But you can see from this maximally founder-friendly round, Series A seems to be benefiting. On the other hand, let's take a maximally investor-friendly round. We're going to make this senior, add in a high liquidation multiple, we can add in participation. In that round, you see that much of the value of Series B's guarantee has been eroded. It's not kicking in until much later. The guarantee is less likely to be triggered because it's been diluted, subordinated by the high liquidation multiple promised to Series B. Because of this, Series A prefers the founder-friendly future round. As long as everything's priced, investors prefer founder-friendly rounds, and founders prefer investor-friendly rounds. So another application of our model is to price anti-dilution. Anti-dilution is ubiquitous. VCs see it as extremely important, yet we can't price this using existing models. And anti-dilution terms are giving investors additional shares if future rounds are raised below the price those investors invested at. So if we take these terms, what we see from running our model is that these terms don't have a lot of value. They increase the value of shares by about 4%. That value is much lower than a naive model based just on the evolution of the company value. And why that's happening is because future rounds have investor-friendly terms when prices decline. So if prices go down, future rounds get high liquidation multiples, get seniority, get other downside protections. Those downside protections inflate the share price in the event of down rounds. And because of that, anti-dilution doesn't end up triggering. If we assume future rounds have common equity, anti-dilution has 3 times as much value. But because future rounds tend to occur with high liquidation multiples, at least as long as they're down rounds, they occur with high liquidation multiples, they occur with participation, with seniority, with other investor-friendly features. These investor-friendly features inflate the value of those shares. Those features prevent anti-dilution terms from being triggered. The final application of our model is to look at exits and to look at market prices. So if we look at exits, we see that high overvaluation is associated with worse exits. Basically, everywhere we can measure them, it's also associated with price decreases. If you have high overvaluation, your future round is at a lower price, which should make sense if you think this has some relation to underlying value of the companies. We also applied our model to market prices. This is going back to Jay's question, looking at the value reported by different investors. So on this chart, what we're doing is we're looking at financing rounds that were raised around the time of value declarations by different intermediaries. So we have mutual funds in blue, we have specialized intermediaries, which are Sheriff Post or Hercules Capital in green, and we have 409A values in red. And we take, for each new financing round, we take the values reported by these holders of securities, we take their reported values, and we compare them to the new round's price on the y-axis and our model price on the x-axis. For mutual funds, you can see that the observed prices, the reported prices, are overwhelmingly equal to 100% of the new round price. Mutual funds are overwhelmingly marking everything to the price of the most recent round. The specialized intermediaries in green are being a bit more creative. They mark about half of their investments to the price of the most recent round. They mark other investments down much more. Overall, they're showing much more sensitivity to contractual terms, which matches what we think they should be doing based on our model. The red triangles are tax valuations, and you can see those just are all over the place. They have no real relationship with our model prices. Our model prices, again, being the black line. The green line matches reasonably. Specialized intermediary values are close to the model. Mutual fund values are too optimistic. They don't consider future terms. 409A valuations are very far from reality. So as Michael's pointing out, the 409A valuations are the value of common shares. We're taking our model, we're pricing common shares based on our model. So this triangle right above 50% is a common share that we say is almost worthless because it's been subordinated by preferred, or sorry, is a common share that we say is worth 50% of the price of the most recent round, and that the 409A valuation says it's almost worthless. The common pattern we see here is 409A valuation saying common shares are worthless, when our model says these shares actually have value. This isn't surprising because 409A providers talk frequently about understating values, but I think it's important to emphasize, given this seems to be a flaw with the existing tax code. These valuations are supposed to reflect reality, and yet they don't seem to. So, to conclude, we build out this valuation model incorporating future rounds. When we do this, we see that if you ignore future rounds, you give about 50% too much value to seniority or to liquidation multiples, primarily because of this precedence relation. Founder-friendly terms for founders, at least in fairly priced rounds, and investor-friendly terms hurt investors. Anti-dilution terms are important, but perhaps not that important because of the decrease in value of them caused by investor-friendly terms being issued in down rounds. Overvaluation predicts bad outcomes. If you're more overvalued, your company tends to do worse relative to its nominal, relative to its reported price. And finally, the tax declarations and mutual fund marks seem to be inaccurate, with tax declarations being low and unrealistic, and mutual fund marks being high and not sensitive to terms. There are some caveats here, which I'll mostly defer to Oleg, ranging from the fact that we ignore governance to the fact that we're abstracting away from things like pro rata rights or the composition of the investor body. But we see this as an important contribution, focusing on the cash flow rights, understanding how future financial rounds impact cash flows. So thank you for listening to my presentation. I'll hand things back to Mike or to Oleg.
Great. Thanks, Will. That was wonderful. To present our discussion is Oleg Gredil from Tulane. You've got, I think it's 15 minutes, Oleg. Sometimes I forget. Yeah. Great. Ooh, there you go.
Oh, yeah. Can you hear me? Wonderful. And you see my screen, right? Fantastic. Thank you very much for the opportunity to discuss this great paper. I will start by recasting sort of the problem and the findings. So first of all, why do we use this post-money valuation as a way to measure around prices? It roots into that sort of old school textbook venture capital methods, right? In which the way you evaluate the value of the claim in a startup is by thinking about what is the good state exit valuation for this particular startup could be, and then discounting at some target multiple, which is perhaps reflective of some idiosyncratic risk as well, and then multiplying by two things. First one reflects the contracted ownership that is on the assumption that everyone converts, and the good state, everyone wants to have common equity, for example, that's an IPO. And then you're going to multiply by another thing, which is the retention coefficient, which accounts for dilution coming from future rounds. Okay, and in this case, it can be made pretty sort of obvious that a reasonable estimator of the company value today, right, as of day T, is dividing that equity claim value that you just paid by the S-converted ownership, right? So that's the sort of rationale behind this post-money valuation. Now, what the previous paper by Will and Ilya showed is that in venture capital round, investors get far more than just pure equity claim. Instead, what they're getting is a bundle, okay? And if you're gonna just scale the share price of your from your cap table by the number of shares outstanding on a fully diluted basis, what you're gonna do implicitly, you are going to assume that all these other rights are equally sort of present and available for other investors. In other words, you're gonna overestimate the value of the firm as a whole if you're gonna scale the amount tendered by S-converted ownership, which what this PMV method boils to. Okay, so that's the background. Now, what does this paper do? This paper basically shows that, look, these other rights are also subject to dilution. Okay, so this retention coefficient in front of these other rights is also significantly less than 1. Okay, now, yet PMV remains a pretty crappy estimator of value nonetheless. But the magnitudes of these retention coefficients, they vary very much non-trivially, and sometimes you have no idea why they move the way they move. Now, important takeaway that Will talked about is that it seems like what it gives you is essentially another degree of freedom to protect founders. So long as some previous investors have significant other rights to dilute, you can protect founders, but diluting them in order to raise more capital per unit of equity sold. Okay, so that's the key point. Now, let me say again why this is very cool. That's precisely why we want to have complicated models in this profession, right? you cannot tell without the model what is going on there. And even if you understand option pricing and term sheet crafting, you cannot really tell what whether it's a wash, how much is going to matter, and that's why this paper is an essential toolbox provider. Next, as Will mentioned, there are significant implications for someone who is potentially confused about the value of these other terms. And possibly we can have secondary trade in venture capital fund stakes eventually taken off, thanks to that paper in particular. Now, the other thing to like about this paper is that they use a very large and comprehensive sample of deals and document empirically what are the most relevant terms. And they also show this new spotlight give new spotlight on how different the marks are across different stakeholders of these venture capital securities. Okay, so let me tell you what the comments outline going to be. I'm going to start with talking about interpretations, and maybe I can refer to it as a labeling. Then I'll ask you to possibly provide a little bit more of the analysis you already have conducted. So just a few more tables based on what you already have. And then maybe I'll convince you that some additional analysis will be helpful. And I'll wrap up hopefully in time. Okay, so what I'm calling as labeling is what you call overvaluation. Now, from your abstract, we can say that, okay, the model shows that post-money valuations exceed fair values by 40%, ignoring future rounds, overstates the valuation impact of liquidation preference by more than 100%. Very, very strong statements. And I like them, they are true. So I was trying to think, okay, maybe they're a little bit ambiguous. Let me try to reword them a little bit. How about that? The widely cited post-money valuation metric provides a highly biased estimate of how investors actually value the entire company based on the terms of a financing round. The average upward bias is 40%. It is reduced to a fraction of what it would have been if future rounds were impossible. Horrible, right? Why would anybody read that? So understand like why you have what you have in the abstract. Nonetheless, at the same time, you also make it very clear, like what you mean by overvaluation term, right? You're taking, basically the amount tendered for the term sheet as mapping without any bias to the value of the firm, okay? So what the notion of bias here or overvaluation is pertaining to is the ratio between this PMV and that estimate of the value of the firm, okay? So I think it's nonetheless quite possible that some readers may take away that the amount tendered is somehow too high relative to the X, okay? Or at the very least, someone is getting some unfair bargain here, okay? And what could prevent the confusion? Of course, carefully reading the paper, which is always good. If you read your previous paper as well, that would be even better, okay? Nonetheless, if you draw a more clear distinction between what this as reported PMV is and what the actual value company is in the introduction, that'd be also helpful, okay? That's my first comment. The second comment pertains to this very important channel that you have discussed on value transfer to the founders. So you're saying that in all cases, future rounds with investor-friendly terms transfer value away from existing preferred investors towards common equity, thereby reducing our valuation. Because basically investor-friendly terms make it debt-like investments. And that's your table, table 3B, where you show that, so there you have different securities and what happens to them under the model, and what happens to them if there are no other rounds, and what is the consequences of founder-friendly and investor-friendly rounds. Now, the away part, the fact that it transfers from existing preferred investors is very clear. The towards part, not as much. So, taxes aside, issuing a fairly priced debt in and of itself should not create an NPV for the equity, okay? So if there is some kind of equilibrium sort of backdoor effect, then I suggest you show it in the following way. Show us for each line in this table, what happens to the founder's common equity in the respective row of that table if you have a founder-friendly round or investor-friendly round. If there is a transfer towards common equity of the founder, you should see an increase, okay? So that's my comment number 2. Now, another way to think about these overvaluation dynamics is to measure expected melt of these rights. Now, just what you have in your table 3, I suggest you have another table that would tabulate the sort of expected melt. If you can measure it as a retention coefficient or somehow else, given what round you're in and what security you're using. Okay, so you're not conditioned on exactly what you're going to issue in the future, but what on average happens. Okay, suppose you're doing a standard CP in round A. What is going to be the reduction in the this other rights that it gives you relative to a case where there are no other rounds? Okay, so just have this tabulated and do the same for another sort of set of columns. For example, number of future rounds. I think that'd be a very valuable table, and perhaps conditioning on some other things like future value declining would be also very helpful. And the benchmarking it against the retention coefficient or the melt in the actually equity rights would make it even better. All right, a couple of cheap shots. Okay, now you say that yes, we have to basically make assumptions about shocks being orthogonal because we need to estimate this thing, right? It has to be estimable. Now, what is not clear is how costly these assumptions are. For example, I suggest you simulate two economies which are observationally very similar. Okay, they have similar deals, and one of them has correlation between the shocks, the other one does not. And then you estimate your model on both of them on the assumption that the shocks are uncorrelated. Show us whether the key estimates are going to be affected or not. I think that'll be a very easy way to address many of these critiques along these lines, just as the constant drift assumption. Okay, so I see why you said it where it is. I understand why it matters. Now, what I'm not as sure about, given that all the evidence we have about variation in the excess return on venture capital, whether it may actually explain, at least partially, the downward trend in Figure 5, or the estimates of overvaluation conditional on down round and across industries. Okay, so maybe simulation is a way to go here, or maybe making some time variation based on empirically observed proxies is another way to go. All right. So I'm almost done here. So let me actually just ask one question. What about cumulative dividends on convertible preferreds? It's another way to grow liquidation multiple over time. I'm not sure exactly how you model that, whether you consider it at all. The other thing, so in table 5, basically you ran a regression A. And I was thinking, why didn't you run regression B, for example? It seems like for B, we have very clear predictions of what the coefficient should be, right? So basically replace your change with your model-based value. And PMV should not explain anything if your model-based value is actually correct at predicting future exits. However, this gamma 2 can be very useful coefficient to examine if your outcome variable is low value M&A. For example, so the question here is that whether picking high sort of liquidation multiple security, that's going to create biggest sort of bump into PMV, will push the company to exit for a low value M&A. So that's an interesting sort of side test you can get pretty much for free here. Also, you can potentially include the prices of the IPOs and M&A into model estimation. I wasn't entirely sort of clear why you say that potential mispricing would benefit VCs more. For example, on page 16, if they buy more debt-like securities, it shouldn't be the case. Perhaps a little more discussion would be helpful. And finally, I would sort of ask you to push a little bit more the normative aspect of the paper. Would you say that people should use actually the adjusted PMVs instead? Perhaps take the output from the table 3 and adjust their PMVs when they report? Is that the way to go? It'd be good to know. All right, so that's it. Very important paper. It's a first glimpse on that sort of dynamic effects on how you allocate, these cash flow rights and other rights when you have staging. Okay, we don't have anything at this point before this paper on that matter. And I think there's room to flesh out the implications even more. And simulation-based evidence can help alleviate some identification assumption concern. All right, do spend some time and maybe write a little bit more boring way what the PMV really means and what is the valuation statement is about. That's it. Thank you so much.
Wonderful. Great job, Oleg. That was super helpful and under time, even better. So we'll give you a chance to respond, and then we'll see if anyone wants to step up and ask any questions.
No, thank you so much for the truly excellent discussion. I actually really appreciate it. I think your framing of things is melt and showing the breakdown of equity values for the value preferred as being common equity plus the value of the additional guarantees is a really intuitive way to think about that. I'll work on trying to revise the paper to bring some of that in because I think it has a lot of value. I agree broadly with most of the other comments. I mean, a lot of them are thinking about the trade-off between making things more precise and making things more legible and making things more impactful.
Yeah,
But
don't
it seems
change
like,
the abstract though. Definitely don't. But at some point in the introduction, maybe it's worthwhile, giving some caveats, and because people, will conclude that look, all these prices are all over the place and they are wrong. But price is not necessarily wrong by per se. It's like the interpretation of them is wrong.
definitely, and I agree totally. It's something we're struggling with, but we'll try to do a bit better in making sure that people aren't coming away with the wrong impression. Because you're right, people will read the first five, especially people, practitioners, are going to read the first 5 sentences of the paper or the first 5 sentences of the abstract. Thank you.
Exactly. Thank you.